So what will that strong, durable good report and comments from the head of the European Central Bank mean for the Fed when it meets next week? We're joined by Rob Martin, Senior U.S. Economist at UBS. Welcome, Rob. Nice to have you here.
Yeah, thank you for having me. I appreciate it.
You are expecting a cut of at least 25 basis points. Does what happened in Europe today with Mr. Draghi's comments or the durable goods report change your attitude about what's going to happen?
Well, let's focus on the data first. This morning's report on durable goods was just one more piece of evidence that the U.S. economy actually really is doing quite well. It's growing nicely. We've had a string of strong reports. So far, the Fed has looked through them, but the evidence is accumulating. That's going to reduce the risk of a big cut.
And also, Fed Chairman Powell has been mentioning the global economy, which clearly is slowing down. China, parts of Asia, and even Europe at this point. So a rate cut next week, would that be not just for our economy, but for the global economy as well?
Well, it's not so much that they would cut rates for the global economy. It's that they worry that whatever is dragging down those other economies, whatever is weighing on growth in Europe, whatever is weighing on growth in Asia is also going to affect the U.S. economy, both through the direct ties, through trade, for example, and because the U.S. is subject to those same kind of uncertainties. The Fed already believes that there's a confidence shock working its way through the economy. The weakness in Europe is one of the reasons they really want to cut rates. But the strength of U.S. data, the strength of the U.S. economy, makes it difficult for them to go big. And that's why there's this debate between 50 basis points or 25 basis points.
Right.
We see 50, but 25 is clearly on the table. Either way, they do want to provide accommodation.
A lot of times the market looks to what the Fed says after its actions. In other words, the statement. Are you expecting any major changes in the language that the Fed uses?
No, we think they'll be pretty comfortable with their language. Whether they go 25 or 50, they don't want to signal that they're completely done with rate cuts because they're still nervous about the outlook. They want to wait and see how the data is going to evolve. And so I suspect in their new language that they will be closely monitoring the economy coming into the September meeting as well.
I mean, you have to admit, it is a rather interesting time for them to be cutting with the consumers so strong right now. The employment picture, the best in 50 years, and yet inflation is not where they want it to be.
That's right. So inflation simply refuses to move up to 2%. They've got these worries about foreign growth. They've got worries about that confidence shock. This is what's driving them. So it feels that there's some tension between what they want to do, cutting rates, and what we're seeing in the economy. But to be fair to them, that low inflation and those real concerns about foreign growth push them to some kind of easing in the near term.
We will see. Rob Martin with UBS. Rob, thanks.
Thank you.